Good afternoon. Welcome to Cannabis Live. My name is Travis Copenhaver. I'm joined today by a very special guest, Vinar Ayar. We're going to be talking about different tax considerations for cannabis businesses with a little bit of a focus on preparing for and dealing with an audit. We're going to get into that right away. But first, we'd like to announce a seminar that we're going to be doing coming up on September 27th. It's going to be a Friday. This seminar is going to be preparing currently open and operating cannabis businesses as well as pending applicants for a variety of topics to be prepared to have a compliant future success. We're going to be touching on a lot of topics. One of those topics is going to be how to deal with IRS audits. We're going to have Vinar come join us and have a great show about that. We're going to touch on a lot of other topics: regulatory compliance, how to raise capital, overcoming municipality challenges and restrictions, developing and acquiring brands, doing licensing deals, etc. We hope that you join us. There'll be more information on our website. Again, the seminar is going to be September 27th. Please feel free to join us. We'd love to have you there. All the topics we're going to be discussing at that seminar are going to help you not only continue operation, but run a more successful operation. Now we're going to give a quick rundown of today's news. Just a couple topics to cover today. The first is we saw 3 ballot initiatives for recreational marijuana over the last week here. Unfortunately, those 3 ballot initiatives all failed. There were ballots in Highland Park, Crystal Lake, and Vanderbilt. We're going to continue following different groups as they try to use the ballot process to opt either in or out of recreational marijuana. And we'll certainly be doing future shows and things discussing those topics. But unfortunately, so far, the couple groups that have tried were unsuccessful during this first round. The next real big important topic of news we want to cover this week is the regulatory assessment fees for fiscal year 3. That'd be most of year 2020 have been announced. And similarly to the way they broke down the regulation fees for the adult use industry, we're going to be seeing something similar deployed for medical marijuana. They are going to be tiering out the regulatory assessment fee based on license type, and they're also going to be deploying the what they call tier level for renewal prices. While we don't have all the detail that we got in the adult use regulations, we can assume that they're going to be very similar to that. I'm going to run through them quickly here for you, and just so you're aware, they go into effect October 1st. So the Class A license is still $10,000. A Class B license will now be $30,000. A Class C will be $56,000. A processor will also be $56,000. The provisioning center will be $44,000. The secret transporter will be $44,000. The safety compliance facility still does not have a regulatory assessment fee. Similar to the adult use regulatory assessment fee renewals, there's going to be tiers of output. So the grower is the easiest to understand. If you have the top 33% or the top tier of output as a grower, you're going to be paying a slightly higher regulatory assessment fee. If you're the average, it's going to be the same as the initial fee. And if you are one of the lower tier, you're going to be paying a slightly lower fee. I'm sure we're going to get more information about this as we gear up for fiscal year 3. Just be aware that the current regulatory assessment fee is $66,000 per license. So all of the fees have gone down, and they are now tiered a little more appropriately to the size of those businesses. That's our news for today. We are now going to shift to our topic. Like I said, we are joined today by Vinar Ayar. Vinar is a tax attorney. Can we have a couple statements about who you are and what you do?
Thank you so much for having me.
Oh, thanks for joining us.
Vinar Ayar. I'm the founder of AR Law. I have my own tax law firm right here in Farmington Hills, Michigan. I'm not like most tax attorneys, though, because I don't really do much planning or transactional work. My specialty is defending people against audits and other disputes they might have with the IRS or the state taxing agencies.
Oh, that's perfect for today's topic, because that's what we'd like to talk about. So we have talked about tax issues on our show a couple different times throughout the various shows. And usually what we're talking about is 280E. We're going to touch on that for a second, but we're going to quickly move away from that towards audits in general. But just generally, what is 280E? Why does it matter to cannabis?
Yeah, so most people who are familiar with the cannabis industry have probably heard about this, but cannabis businesses, because they're still federally controlled substances on the controlled substance list, they're taxed differently than other businesses. Section 280E is a provision of the tax code that disallows otherwise deductible business expenses if you're in the business of quote-unquote trafficking a controlled substance within the meaning of the Controlled Substances Act. So in layman's terms, marijuana businesses don't get to take business deductions.
And I think it's pretty safe to say all of our license types qualify for trafficking a controlled substance, right?
Right.
Yeah.
Right. So the one thing that they do allow in 280E is cost of goods sold. There was some court cases that came down that says you get to write off what it costs you to produce or sell the marijuana. You just don't get to write off other business expenses. For example, your rent or your utilities or payroll. So smart business owners are doing some careful planning up front with their CPAs or other tax advisors to kind of structure things to minimize their taxes and mitigate the effects of 280E.
Awesome. So when we brought you in, though, 280 is obviously super important to cannabis. What we'd like to talk a little bit more about is some other tax issues that don't get as much focus. And I think a big one that a lot of attorneys I work with in Michigan don't really touch on as much as I think they should is, what's the deal with an audit? You always hear cannabis business, it's not will you be audited, it's when you're going to be audited. Let's talk first a little bit about like corporate structure. Knowing that a tax audit is very foreseeably in your future, what's kind of the best practice for putting your company in a position, knowing that's the case?
Right, so there are generally different ways you can set up a business. You can set up as what's called a sole proprietor, or sometimes you can do an LLC or an S Corp, or you can do a C Corp. And I think the most important thing for preparing for an audit is to choose the right structure, because they have very different tax consequences, especially if you get audited and things go badly like they have for many marijuana businesses. So if you set up as what's called a sole proprietor, which means you're directly liable for all the tax, and you only file one return, everything goes right on your personal return, which means if you get audited and you owe a bunch of money, well, they can come after all your personal assets, and it's just all your income. So likewise, with an LLC or an S Corp, they have what's called a flow-through tax, where you actually file two different tax returns, but the income still ends up on the personal return. And you have the same kind of considerations where, there's less protection in the event of an audit. And then you have C Corps, which are generally used by larger businesses and those that are publicly traded. But in the cannabis industry, I've seen a lot of people with their tax advisors opting to go for the C Corp route. Kind of, although you pay a little more in tax, there's something called double taxation, where the corporation has to pay income tax and then the individual has to pay tax again when they take the money out. People are paying and choosing to pay the extra tax for the extra protection they get, because then in the event, if you're audited, then the corporation and the corporation alone would be responsible for the income tax under most circumstances.
Right.
So you couldn't lose your house or your car or your other assets. Your losses would be limited to what you've invested into the company.
Right. I'd say in my experience, preparing a lot of these applications, a lot of groups will choose the LLC corporate structure. But it's important to remember that's corporate form, which is different than how you're actually taxing that entity, correct?
Right. So we're talking about tax structure. When I'm talking about a C Corp or an LLC or an S Corp, I'm sorry, not an LLC, I would say a partnership. Because you can be set up as an LLC and you can choose any of those tax structures. So although most people say LLCs are taxed as partnerships, that's just the default rule. It's as simple as sending in a form with the IRS, and you can elect to have your LLC taxed as a corporation, either an S or a C. And I've been seeing a lot of people choose that route because for state law purposes, LLCs are a lot easier to maintain and less expensive. For example, you don't have to have like shareholder board meetings and
a lot less
board of
corporate work
directors
to keep managing of. It's cheaper a lot of times to set it up, etc.
Right. So you can be an LLC, but for tax purposes, you can be treated as a C Corp.
Got it. So, like I said, I think the vast majority of applications we put together are LLCs, but my advice to those groups is always, put yourself in a position to have the option to tax yourself as a C Corp. But structure is what it is. Let's really focus on the audit. So knowing that an audit's probably in your future, what are some things we can do to prepare for that inevitability?
Yeah, I think so. The most important thing you can do to prepare, other than planning ahead before you engage in the transactions, is to make sure you have all your records in order. Generally, when the IRS audits somebody, they're looking for verification on the numbers of the return. And it's usually a pretty easy thing to do for most businesses because they have bank records and credit card statements, and there's a paper trail of all the money that came in and went out, at least theoretically. However, with marijuana businesses, there's more challenges with the record keeping aspect and with the IRS being able to verify your deductions. So I think it's really important to keep meticulous records.
Yeah, let's talk about what some of those records are. I know you and I talked about a little bit before the show. You know, one of the deductions we can take is cost of goods sold. So let's assume I want to take advantage of that. Like, what kind of records would I need to do that?
Right, so let's first talk about what cost of goods sold is. Because when you first hear that word, you think it's simple. It's the price that you pay for the product. Let's say you're a retailer, you're a provisioning center. Your cost of goods sold would be what you pay to acquire the marijuana, which you might tell me, well, that's all tracked in metric and all so on and so forth. But a smart tax advisor would tell you that there are other things that can go into the cost of goods sold. For instance, the packaging supplies for the plastic vials or the bags, and also the labor it takes to prepare the product for use, and also the overhead and the rent it takes for storing the inventory. Right. So some of the records we're talking about are records to support these other expenses. For example, if you want to take a portion of your rent, you should actually measure out the square footage of the inventory control room and compare that to the total building and come up with a percentage. Or another thing sometimes people want to write off is the cost of the labor for the packaging and preparing the materials. If you want to do that, there's two approaches. Either you make sure your employees have different time cards and they punch in on this clock if they're packaging and rolling, and then punch in on the other clock if they're doing one of the other functions, or you can conduct a study, and you document the study and you run a test for say a couple weeks of how your employees spend their time, and then you can allocate a certain percentage of your payroll and say, well, this percentage is cost of goods sold. I've heard of a lot of accountants just telling their clients, well, we're just going to take 20% of labor as cost of goods sold, or throwing these percentage numbers out there, which a lot of people do their rule of thumb approaches, but in an audit that just won't hold up.
Right.
And it's your responsibility to prove your deductions. The IRS won't give you the deductions if you can't give them the basis for it.
Right. So it sounds like try to understand the types of deductions you're aiming for and make sure you have evidence to support those. Right.
Yes. And then the other thing I would say is to have everything organized and to plan out your strategy for the audit in advance when you get the first letter. You don't want to be scrambling to respond. You should understand what the process looks like. Usually the IRS will ask for an interview with the taxpayer, but if you have your own attorney or accountant or somebody representing you in the audit, you can usually have them speak for you. The process for an audit is generally a series of back and forth information requests and responses, and I always tell people to make sure you're organized so when it comes time to prepare your response, you're in a position to quickly give the auditor what they want and no more, no less. You never want to give them more than they ask for, and you never want to give them incomplete responses.
Sounds a lot like a cannabis application.
Right.
Let's kind of lay the groundwork for people. Personally, I'm not had to go through an IRS audit before. Yeah. What's just generally what the audit process is, and then let's maybe focus on how it works in a cannabis perspective.
Yeah. So generally, the first step in an audit is a return will be selected by usually a computer. It's usually something on the return that flags it. Of course, all the marijuana businesses are going to be flagged for audit. It's just a question of not when, but how often also, because it's probably going to happen more than once. So the IRS will select the return for audit, and then the file will work its way down to the local office. They're never selected by the local group, just in case they know some of the people that they're working on. But once it's selected, it gets assigned to an agent locally. That agent will start with a pre-investigation. They usually know a lot more about you than you think. And then after they've done their pre-investigation and kind of looked in and built the foundation of a case file, then they'll make their initial contact. And they're trained in their initial contact to ask as much questions as they can and get all the most important information out, because usually that's their first and only chance to talk to the taxpayer without having any kind of representative present. Usually the initial contact will be a letter followed by a phone call, or sometimes just a visit. An IRS agent might show up and tell you you're under audit and just go right in to start asking questions. And then after that initial contact, my advice to people is usually to just slow the conversation down and try and put a pause on things until you can talk to an advisor and figure out your strategy. After the initial contact, they'll issue what's called information document request. It's a formal request by them in writing of all the information that they need from you. And it'll ask like your prior year returns and your subsequent returns and your bank accounts and a list of the businesses you're involved in and some background information. Normally an audit starts with, they'll just pick one or two line items they're auditing. Of course, on a proper 280E return, there's really only two line items, gross receipts and cost of goods sold, and then that's your income. So you know they'll be testing the gross receipts and the cost of goods sold. They send the first information response, and then they'll send follow-up responses from there, and as it leads them to more and more information.
Gotcha.
Another part of the process is they oftentimes make third-party contact for information, and a lot of times, like in a regular non-marijuana business, they'll ask for all the bank records and copies of all the canceled checks and all the deposit slips and all that stuff. And if you don't give it to them, they'll just send a summons to the bank and get it. And it's usually not a big deal. They'll just send out summonses to your banks and your credit card companies, and they'll get the records and they'll compute your income. With a marijuana business, if they want to make third-party contact, it's more difficult because they can't simply summons a bank account and get records. They might actually start subpoenaing or summonsing your different vendors or caregivers or other third parties
especially
for
in this
information.
first year, right?
Yeah.
So assuming like not only for your business, which is likely to be undergoing an audit, let's imagine I'm a grower, right? Would they potentially, if I'm working with a provisioning center purchasing my product and they are undergoing an audit, that might impact me as well, correct?
Yeah, I've seen many audits start. So I talked about audits being selected from the central unit, but also once an examiner gets a file, they can open, a series of related cases, and usually that's how it goes. It'll start with one party, let's say they get a provisioning center, and then they'll get a list of all their suppliers, caregivers, or other licensed growers, and they'll start looking. If they have a reason to think there might be something wrong, then they'll start selecting the other ones for audits. I'm seeing that happen a lot now with some of the gray market operators where kind of everybody gets audited. I expect some of that to flush out when some of the MMFLA licensed operators, because there's less of a inference that you're up to something wrong
State compliant.
when they're all state compliant, because historically a lot of people who have been in this business haven't really been paying all their taxes. So once they get a hold of a list of people they're going to start checking, I think in the future you have less risk of being harassed just because one of your customers got audited or something like that.
So Bernard, what would the difference be when this audit's underway if like I'm a flow-through LLC versus like a C Corp? Like is the process the same and it's mostly a liability distinction, or is the actual audit different as well?
That's a really good question. More or less the process is the same. The audit is a little bit different because there's different issues they have to look for. For instance, with the C Corp, they're looking for dividend tax and they're looking for distributions. With an LLC, they might be testing your basis in the company. So there's different numbers they want to test, and every number that they want to check has a different method attached to it. Other than that, the main difference is with the liability and the risk you're taking. Most of those audits will be handled. Where you get the biggest difference is when you distinguish between the small business and self-employed division of the IRS and the large business and international division. So when you get to a certain size, and that's when you start to see the audits being different. All the small business audits are more or less run the same way because they're all run by the small business department at the IRS. The larger enterprises are handled by the large business and international division at the IRS, and those are quite a bit different as far as the process and the timeline and so on and so forth.
Gotcha. So, we kind of gave an overview. Let's maybe kind of do like a little bit of a case study. So, what if I'm a grow? It's my first tax year of operation. Like if I were coming to you to help me, understand I'm going to have an audit, like what would the difference for a company that's set up to be a grow as opposed to like a provisioning center? Because I know like a lot of these groups, especially smaller groups, ones that haven't had enough time to really dedicate the effort they need to really prepare themselves the same way a larger group would. Is there a big distinction between what a grow's doing versus a provisioning center? I know I always tell people, well, a provisioning center has potentially hundreds of cash transactions a day versus a grow, which has, easier to measure batches, probably on a lot more predictable schedule. Before we get into what happens when you have both of those things, like what would your advice be to like a grow, anything different that they would be concerned about versus someone who's proposing to operate a provisioning center, et cetera?
Yeah, that's a really good question. I think that The biggest difference is if you have a grow, it's a little more forgiving. Because if you're growing marijuana under the tax law and under accounting principles, all the expenses you have that are directly related to the production of the marijuana would be included in what's called your cost of goods sold. That's the vast majority of the grow's expenses would go into things like the equipment and the utilities and to power the lights and the nutrients, and then the square footage for the facility will be mostly used for the production of plants, as is the labor. So I think as a grow, it's a lot more forgiving if you don't do, all the planning up front, although you always should. With a provisioning center, you have a lot more to risk because there's a lot more allocations that need to be made to try and really maximize your deductions. And the other thing that really is different, and I'm glad you mentioned how the grows receive fewer payments but larger amounts, you have to always be careful of what's called the Form 8300 compliance.
Yeah, we were gonna mention that. Let's lay out just in a non-cannabis perspective what that is, and then how it might impact some of our clients here.
Yeah, so a lot of people know that when you go to the bank and you deposit more or withdraw more than $10,000, they fill out something called the currency transaction report. That's a report that's required by financial institutions to fill out whenever somebody handles more than $10,000. There's kind of a similar form that not that many people know about. It's called Form 8300, and that requirement applies to non-financial institutions who don't have to do currency transaction reports. And the rule is if you receive more than $10,000 in a single transaction or in a series of related transactions over the course of a 12-month period, then you have to report the transaction to the Financial Crimes Enforcement Unit at the IRS. So you have to fill out what's called 8300. You have to identify who's bringing you the money. You have to identify the denomination of the money. So you have to count it out and say this many fives and this many tens and this many 20s and how much the transaction was and the nature of the transaction. And the trick is, and the trap in these forms is that they're not due at the end of the year when you do your accounting and your 1099s and so on and so forth. They're due within 15 days after the transaction. So we're talking, so with a grower has to be conscious of that because they're a lot more likely to receive more than $10,000 from one person in either one transaction or a series of related transactions. For example, if you sold a batch of product and he paid it in monthly installments, and the payments were less than $10,000. Well, they're all related, so they all have to be added up. Okay. And so the provisioning centers have less of a concern because they're far less likely to have one customer come in and purchase $10,000.
So it is customer based, though, right? So like if Travis, the cannabis patient consumer, I would have to personally spend $10,000 to trigger that form, right? Well, it's not 50 consumers that come in the hour. It's each. Right. It's one vendor, right?
It's close. It's transaction based, which I think in a provisioning center is more or less the same as consumer based. They would have to be related transactions, meaning not straw purchases or whatever the case may be. But yeah, that's basically the idea. And the key is this applies to all businesses. This is not specific.
Not cannabis, right?
So another group of people that need to worry about this form are the ancillary service providers who deal with cannabis customers, landlords, or if you're in the business of selling supplies, packaging supplies to the marijuana dispensaries, anybody who caters to the marijuana market, even us attorneys and accountants, and that we're paid in cash. I have a tally that I keep track of all my clients, and as soon as the clock hits 10,000, we send out the form, we reset the number back to zero, and we kind of come up with a system to track that.
I have to assume your primary payment methods for receipt is cash, like ours is as well, right?
Well, with the cannabis clients.
Yeah, with cannabis clients, for sure. Great. Are there any other big audit topics that you think are important for people to be aware of?
I think that the biggest takeaway is not to go into a situation unprepared and to not do this unrepresented, because the IRS agents usually have a lot more information, and you need to have they have the benefit of knowing what information they need. The biggest mistake I've seen people make, even people who haven't necessarily done anything wrong, is that they phrase things in the wrong way or they say the wrong thing and they create a big problem for themselves. And I think the biggest takeaway is to prepare thoroughly and to not go it alone. In my office, we don't let our clients talk to the IRS with us or otherwise unless there's a court order, because I've just seen it go badly too many times. And I've seen people who, when they get audited, the other tip is it's usually not a good idea to go to the same guy who did the return to also defend the audit, it's, in my opinion, a conflict of interest, because if there is a mistake on the return, the accountant's going to want to blame the client's going to want to blame the accountant. It's probably best to get somebody who had nothing to do with the preparation of the return to handle the defense of the audit.
Right, fresh eyes.
Yes.
Well, Vinar, thank you so much for joining us. If you want to be prepared, as Vinar suggests, I would highly recommend that you join us for our seminar coming up on September 27th. Vinar is going to be one of our speakers there. I'm going to be there. Most of the attorneys at CLG are going to be talking on different topics about how not only to prepare, but also how to operate and keep your business compliant. This is going to be our 12th seminar over the last couple of years on cannabis. We'd be happy to have you join us. It's September 27th. It's at Kobo. It's Friday. Please find more information on our website if you're interested in coming. We'd love to have you there. This has been Cannabis Live. Vinar, thank you so much for joining us today. We appreciate it.
Thank you so much for having me.
And thank you for watching. We'll be here next week. Just so everyone knows, we're going to be focusing on some basically teaser topics for the next couple of videos leading up to our seminar to kind of give you a taste of what our seminar is going to be focusing on. The seminar itself is very much for people who are either currently operating or intend to be operating cannabis businesses, so we can really give you direct information. A lot of our seminars in the past have been like, here's what's going to be coming, here's what's going to be happening, here's what the rules might say, here's what the rules say. Well, we now have businesses up and operating, and if that's either you or a business where you want to be the operator, we highly recommend you join us. We'd love to have you. Thank you so much. We'll see you next week.